print media, something that we are very interested here in the Financial Times. And so today we're going to talk about Time Incorporated with James Fontanella-Khan of the Lex column. James, Time reported results this morning for their latest quarter. The stock moved down a little bit. Tell us what happened.
The stock was down 8% today, Sujeet, and the reason is very simple. Despite having beat a lot of the forecasts by analysts, the company downgraded its outlook for the year, so it expects to generate less revenues than previously forecast. And this is mainly on declining print advertising revenues. And so it's the same old story. Remember, this is a company that was recently spun off from Time Warner as late as June, and it's already kind of having some problems.
Right, but as far, while the downgrade was disappointing as far as the forecast goes, there are some pretty interesting characteristics of the business that are compelling for investors. What are those? So
the positives here are there's three. The first one is that they're managing to keep costs under control. Production costs, for example, which for a print company are quite big, we're down 7%. So that's a positive. Second point, this is a company that generates a lot of cash flow. And now that it's independent from Time Warner, it gets to keep this cash flow and it can invest this money back into the business, which it couldn't do previously because it had to give it back to the parent company. And finally, the big positive in my view is that digital advertising is growing. And it was up 5% in the last quarter. So this is a positive kind of direction that the company is going into.
Okay, and so we should say Time is a few publications. Obviously, it's Time Magazine, Sports Illustrated, People, which is a big star,
absolutely,
Entertainment Weekly. And so as we're thinking about Time as an advertising-based business, how does it compare its prospects valuation for an investor versus Twitter, Facebook, AOL, Yahoo, these other famous ad companies?
Well, that's an interesting question because they're quite similar. I mean, they're in the same business of selling advertising. And if you compare the two, Time Inc. is way cheaper than Twitter, for example, which, its enterprise value is about 120 times earnings, whereas for Time Inc., we're talking about 7 times. So it's considerably cheaper. And we should not forget the value of the brand that Time has of the publications you've just mentioned is huge, and they can be leveraged in different ways, and that's something the company is trying to do. For example, with events and trying to kind of look at the company in a broader way and trying to move away from the advertising revenue model. So going solo was never going to be easy. But there's hope. It won't be easy, as I said, and we'll have to give it some time.
Yeah, it'll be interesting to see if a private equity firm likes it more than the public market does. Thank you, James.
Thank you, Sujeet.